The top business stories live from the Sky News City studio. Shares jump at Marks & Spencer after half-year profits smash City forecasts. Flying into profit, the long-haul low-cost airline Norse Atlantic has its first profitable quarter in history. And ITV says advertising revenue will be down 8% this year, describing the market as challenging. Good morning, this is Business Live with me, Ian King. Shares of Marks & Spencer have risen by as much as 10% this morning after the retailer reported half-year profits that shattered City forecasts. Well, M&S reported a pre-tax profit before adjustments of £360.2 million for the 6 months to the end of September. That was up from £205.5 million in the same period last year and well ahead of City forecasts, which were around £275 million. Well, M&S said that its food sales during the period rose by 14.7% and by 11.7% on a like-for-like basis, which is the measure that strips out the impact of store openings, closures and refurbishments. Clothing and home sales were up by 5.7% and 5.5% on a like-for-like basis. The company has also, as promised, reinstated its dividend for the first time since the pandemic. Well, joining me now is John Stevenson. He's retail analyst at the investment bank Peel Hunt. John, good to see you this morning.
Morning.
Your note, you said to clients today, you said that they beat census. They beat market consensus by such an extent it was embarrassing for you and your colleagues. Have they been doing a bit of downplaying of expectations?
The wise words of my colleague Jonathan Pritchard. Yeah, no, they've not played it down. They have literally blown the doors off. I think management teams are always a little bit nervous. No one wants to, put everything out there. And yeah, there's a few tailwinds. There's benefits of FX. As the cost savings are coming through, but it shouldn't distract from basically an M&S that's really back in the game for the first time in, arguably about 10 years. Yeah,
I mean, now, obviously, one expects M&S to do well in food, and they have again, but it's really clothing and home that catches the eye, isn't it?
It is. I mean, some of the numbers in the detail are quite incredible. Some of the new stores we're getting and we're seeing at the moment, like the one in Liverpool, 30% less space coming out in clothing and home, but profits and sales are higher. They're actually getting the proposition right. They're relevant to consumers once again. And this isn't something that's happening at Marble Arch. Been to, like 20 years of M&S recovery stories, you have a look. Does it actually get out to the regions? Does it get out to the customers? Do people actually see what they're doing? Often looks great in the press show, but actually they only bought 5,000 units of whatever coats in the Christmas advert. This time there's a real sense of intent. I think they've got the right people in the room. They've got a great sort of senior management team that's driving this. And they're actually getting the proposition right. And it's right at the stores in Leeds, the one in Liverpool, the new one in the Trafford Centre that's about to open. They're getting the proposition right.
Is there a sense in which they're perhaps benefiting still from the failure of rivals like Debenhams and the fact that people like John Lewis have been closing stores?
Oh, definitely. I mean, the competitor backdrop there are, again, the lack of Debenhams, John Lewis in the wilderness absolutely all helps. But again, it comes really back to the core disciplines. Food's always done well, but the last couple of years have really been driving the value message and actually been driving prices down. And rather than being a top-up shop, rather than being something you pick up on the way home from work, they're now starting to drive basket size. They're trying to, they're getting the consideration for bigger shops rather than just celebration. You go into clothing and home, and again, some of the market share figures now, I think it's 4 years since women's wear was #1 market share, again this summer, back in that #1 spot. So yes, the competitors are finding life tougher, but M&S is absolutely driving its own destiny.
It's also just bought a distribution business called Gist as well, and it looks like that's already paying off.
Yeah, substantial. I mean, before it was a third-party arrangements. Obviously, you had a management fee in there. So again, that's part of the sort of profit increase we've seen in coming through in the first half. But beyond simply taking out the management fee, they're driving more efficiency and obviously owning the end-to-end distribution logistics network for food. You can make it far more efficient.
Yeah, I guess if there's one blemish on the results, Ocado Retail remains disappointing.
Yeah, I mean, the loss, 25 million versus sort of virtually flat last time. But there's been a lot of investment, there's capacity, and I guess there's again, not to paint everything in a positive picture, but there is latent opportunity. They're just starting to really sort of get more control and get closer to, how Ocado's operating, get more M&S product in there. And so they're starting to, you see a bit of change in terms of the active customer base, but that's, quite a long way to go. Yeah. There are a number of areas. I mean, that's the interesting part of this. Yeah, to management's phrase, it's in the foothills. There's a lot to deliver, and you look at the profit opportunity that's probably more like 800-900 million when they sort of finally recover versus the sort of 640 million the market's talking about today.
Yeah, no, the outlook statement is still a little cautious, I felt.
Yeah, rightly so. I mean, again, there's an element of sort of playing things down a little bit. I mean, they've done so well in the first half. The implication, there's a bit of investment in the second half. Profits will grow by sort of 25, 30 million if you went with sort of the consensus and kind of guidance. It feels like that's a number to be beaten, to be frank. But again, who's going to stand here, in the challenges we're in, a couple of weeks ahead of peak and start calling the market? But it feels like they've got the customer with them this time, so I would expect a good chance of a beat.
Yeah, John, I know you've got to rush off to a presentation now. I do appreciate you sparing the time to chat today. Thank you.
Great, thanks.
Some other business news stories for you now. And the Bank of England said this morning that stress tests on central counterparties, which are the businesses that sit at the heart of financial markets that help clear and settle trades, has shown continued resilience at the businesses. Well, the bank conducted stress tests on 3 central counterparties operating here in the UK: ICE Clear Europe, the London Clearing House, which is owned by LSEG, the owner of the London Stock Exchange, and LME Clear, which is owned by Hong Kong Exchanges and Clearing, owner of the London Metal Exchange. Well, the bank said the stress tests had included scenarios of equal and greater severity than the worst ever historical market stresses. Broadcaster ITV said this morning that it expects advertising revenue to be down some 8% this year on last year, despite the boost of the Rugby World Cup recently. ITV, which described the advertising market as challenging, pointed out the tough comparisons with last year, which saw the second best advertising performance in its history. It said that during the first 9 months of this year, its total sales were up 1% on the same period last year at £2.975 billion, thanks mainly to a 9% rise in sales at its ITV Studios arm. The pub operator JD Wetherspoon said today that inflationary pressures were easing as it reported an increase in investment this financial year. The company, which is currently trading from 816 pubs, said it will invest £70 million this year, up from just under £47 million in the last financial year, with areas of investment including new staff rooms, changing rooms, air conditioning and glass racks above bars to cater for increased usage of brewers' branded glasses. It said that during the 14 weeks to last Sunday, like-for-like sales, the measure, of course, that strips out new openings and refurbishments, were ahead 9.5% on the same period last year. And the founder and chairman of JD Wetherspoon, Tim Martin, will be joining me this afternoon for our programme at 4:30. Reach, the owner of the Daily Mirror, Daily Express and Daily Star, said today it's cutting 450 jobs as part of a cost reduction programme. The company, which is also the UK's biggest publisher of regional newspapers, including titles such as the Manchester Evening News and the Liverpool Echo, is aiming to reduce its operating costs by between 5 and 6% this financial year. It said the savings would allow it to better invest and develop in online products, as well as help mitigate against continuing inflationary pressures that it expects to see next year. And a reminder, you can watch the COVID inquiry proceedings by scanning the code on the side of the screen right now. Now, the long-haul low-cost airline Norse Atlantic has achieved the first profitable quarter in its history. The Norwegian carrier, which was founded in February 2021, reported a net profit of $1.6 million for the 3 months to the end of September. That compared with a loss of $35 million to 3 months to the end of June. Well, Norse Atlantic carried 434,597 passengers during the quarter. That was up from 204,564 in the previous quarter, while its aircraft were 83% full on average, compared with 75% in the previous quarter. Well, joining me now is Bjorn Tore Larsen, the founder and Chief Executive of Norse Atlantic. Bjorn, good to see you this morning. Which are the routes that have done best for you this quarter?
The very best ones actually have been between New York and European cities. So we're flying to London, obviously, we're flying to Rome, we're flying to Paris, Oslo, Berlin. Those have been great routes. And also some of the West Coast routes have been good, flying to LA, for example. So we had a good summer behind us.
Have you been surprised by the strength of demand?
Not really. I mean, it has been reported all over that there would be a strong demand, and we saw it early that bookings were strong, and also the fares were good. We see the same trend for next summer, although it's too early to tell how it's going to be, but so far the sales are looking good for 24.
You've managed to push fares up during the quarter. By what sort of extent?
Yeah, well, we did manage to push them up, but I think we still have a bit room for a little higher fares in the peak season, and we see that simply because we had a lot of demand on some of the trunk routes. But of course, also our expenses have gone up. The oil price were significantly up from the quarter before, and the fuel bill was $20 million more than it would have been if we had the previous quarter fuel bill. So yeah, prices go up, but so does the cost.
What about cargo? It looks like that's still pretty weak. When do you expect to see an improvement?
Again, hard to tell. It's the supply and demand situation. So the volumes are fairly high, but the supply side has been increased because a lot of new capacity have been added to the market. And we see a slight improvement right now, but it's pretty hard to tell.
You've been rolling out a premium offering this quarter. How much more does that cost, and what's the take-up been like?
That is actually a beautiful product. I'm glad you asked that, because it's a hybrid between the typical legacy carriers business and premium economy class, where we have a really good service, a lot of legroom, a lot of space, and the price is surprisingly cheap. It's a little different from route to route, but typically perhaps $350 a leg, and it's very much worth it according to our customers.
You mentioned in the statement, quite intriguingly, you've been approached by several airlines who've expressed an interest in investing in you. What sort of sums are we talking about here?
The sums haven't really been disclosed or discussed yet, but the size of the investment would perhaps be in the region 20 to 30%. And for us, it's not really about the money, because the money is available in the market, and we just had a capital raise which was heavily oversubscribed. So money is available from other sources, but it is, if we can achieve synergies on the cost or revenue side that we wouldn't have without a potential partner, then we think it's of interest. So we're discussing with two right now, and we have also engaged an advisor to have a 360 radar sweep of the market to see what else is there. But we're also good as a standalone, so we have all options open.
That's very interesting. I mean, are these European players or American players?
I'd love to tell you, Ian, but I can't.
OK, well, I had to ask you.
Yeah.
I mean, there's been a lot of scepticism over the years about doing long haul on a low-cost basis. I mean, even Ryanair have shied away from doing it. What is going to be the sort of trick to making this a long-term sustainable success?
It's been shied away for a good reason. I mean, airline business in general is financially very risky, and better being long or short haul. So we have a very unique business model. We fly like a normal airline, selling tickets during summer, and then in winter we are shrinking the operation a lot in terms of the routes we are flying. We're selling many less tickets, but we're flying a lot of charters. So, for example, if you are going with a great company called TUI on your charter holiday, chances are that there could be a Norse Atlantic aircraft flying for them. Or next week, for example, we're flying to the Antarctica. First time ever a Dreamliner is going there for the Norwegian Polar Institute. So it's really about solving the winter where you don't have that demand for people buying tickets, and that is part of the uniqueness to our model. I think nobody has really had our model before.
Fascinating. Bjorn, got to leave it there, I'm afraid. Great talking to you this morning.
Thank you.
Thank you. Now, the oil price has continued to sell off this morning. Maybe Bjorn will be pleased to hear that, amid ongoing concerns over demand. Brent crude at one point today hit its lowest level since the 24th of July. The price is currently $81.12 a barrel. That's off just under 2/3 of 1% on the session. On the equity markets, well, stocks in the Asia-Pacific region largely fell overnight ahead of a major speech later today from the US Federal Reserve Chair, Jay Powell. Well, in Europe, stocks, again, pretty mixed right now. As you can see on the screen there, the MIB in Milan and the DAX actually more or less break even right now. Talking points this morning include the logistics firm DHL, which is ahead by some 3% in Frankfurt, as its quarterly results came in better than feared. Also in Germany, the tyre manufacturer Continental, it's up on its numbers this morning, at 2.75% right now. Here in London, the FTSE 100 more or less unchanged right now. Losses for the mining and energy stocks are balancing out gains elsewhere. Weakness in the oil majors, of course, on the back of the crude price. Marks and Spencer is the leading blue chip gainer. That's the current picture. The share's up some 10.5%. Meanwhile, Associated British Foods continues to attract buyers after its results yesterday. To the downside, Hargreaves Lansdown is currently off by some 3.5%. That is on adverse broker comment. Outside the FTSE, well, the Lloyd's of London insurer Hiscox is ahead right now by nearly 2.5%. That's after a better-than-expected trading update, while ITV is the leading mid-cap faller, currently off by 5.25%. On the foreign exchange markets, well, the pound is continuing to give back the gains that it notched up on Monday this week. Sterling currently off by a third of 1% against the dollar, more or less unchanged right now against the euro. The single currency, meanwhile, off a quarter of 1% against the greenback. A lot of dollar strength in the market this morning. Well, let's speak now to Victoria Scholar. She's Head of Investment at Interactive Investor. Victoria, good to see you this morning. Let's start with ITV. I mean, pretty disappointing statement.
Yeah, I'd say so. And that's been reflected in the decline in the shares, like you say. It's all about the advertising market, really, which the company says remains challenging. It thinks that full year ad revenues are going to fall by about 8%. And that's partly because of tough comparables last year when it was a strong 2022 because of the FIFA World Cup. But there's also the challenging macroeconomic environment as well, of course. And we know that ad revenues ebb and flow with the economic cycle. So amid tough times, we tend to see that businesses cut back on their ad spending. It's a discretionary spend that is easily cut. So those are some of the things that really have been weighing on the shares today. And its reported total revenue growth came in at just 1% in the first 9 months. So pretty lackluster performance.
Meanwhile, JD Wetherspoon continues to thrive amid a pretty tough consumer market.
Yeah, that's right. We saw that it reported strong quarterly sales up 9.5%. And encouragingly, Tim Martin has said that inflationary pressures have eased, even though energy costs are still much higher than where they were pre-COVID. And we're seeing that the stock is trading higher today, extending its gains for the year. It's up about 50% since the beginning of January. I think that its demand has been pretty resilient, even in the face of the weaker consumer backdrop. And that's because its prices for food and drink are lower than some other pub chains. Having said that, it's still facing pressures from inflation with this trading down to supermarkets that we're seeing a lot as well. And that tax inequality that's been discussed a lot by Martin has often punished the pubs and the hospitality sector more broadly. But of course, we're going into Christmas season, so hopefully it will see as we head towards December.
All right, Victoria, we're tight for time today, I'm afraid. Good to see you as ever, though. Thank you. Still to come here on Business Live, we'll be hearing from the Chief Executive of Smiths News after it's published its latest results. Don't go away.
I'm Katie Spencer and I'm Sky News' arts and entertainment correspondent. When you think of Glastonbury, it's mud you want and music. They're going to cross to us live in a minute. Okay.
We always were capable of doing this.
Oh, they're wonderful children as an audience.
Who did that?
Maverick here on the red carpet. I'm so excited. We take you to the heart of the stories that shape our world.
Nor have I ever struck any woman in my life.
There's this illusion of power.
Are you feeling well?
I remember covering the Oscars and that now infamous moment, the Will Smith slap. You can tell from these crowds just how excited people are for the return of Pride.
These actors playing the lead roles were born long after the Sex Pistols broke up.
As a team, we've interviewed some of the biggest stars in the world.
Okay, I'll talk to you.
Don't leave me!
Yeah, okay.
There's no easy goodies. There's no easy baddies.
Thank you.
Thank you.
Bye.
Fly Emirates. Fly better.
Fly Emirates. Fly better.
Thank you.
Welcome back. Smiths News, the UK's leading newspaper and magazine wholesaler, has reported a rise in profits on the back of strong cover price rises, the FIFA World Cup and interest in the royal succession. The company, which is responsible for distributing just over half of all newspapers printed in the UK, reported a pre-tax profit of £32.3 million for the year to the 26th of August, which was up 3.9% on the previous year. Well, joining me now is the Chief Executive of Smiths News, Jonathan Bunting. Jonathan, welcome to you. To what extent were sales flattered by some of these one-off events like the World Cup and the King's coronation?
They definitely made a contribution, but it was circa 1%. So in terms of the strength of the business performance, our underlying results are incredibly strong, and I think expose a bit of a lie that may be in the market that newspapers and magazines are about to die. Far from it.
Well, that's encouraging news for all concerned. I mean, to what extent, though, are sales holding up?
Yeah, I mean, our sales are broadly flat year on year, largely through a combination of cover price appreciation, which we'll have seen in many other industries too, given the inflationary pressures. And we see in the newspaper market in particular, what I would call the quality titles, the old broadsheets, if you like, they're particularly strong.
I can remember from my own time in newspapers, there's always a bit of a cat and mouse game between the retailer and the distributor and the publishers themselves. Has the cut that you take of the cover price broadly remained the same in percentage terms?
It's grown a little as we've renegotiated our contracts over time. But the important thing for our business model is that we do take a percentage of the cover price. So in a market where cover price inflation is very clearly present and is likely to be for the foreseeable future, that works well for our business model.
Now, you're trying to diversify and build new revenue streams as well. One is distributing DVDs and books to major retailers. What's the attraction of that market?
It's not the specific market that's important on this one. It's really a demonstration of our capabilities. So if you think about what we do, we are a very time-sensitive logistics operation. We've been around since 1792, and yet hardly anybody's heard of us. Why is that? Because largely we're delivering in the middle of the night. And actually what we're able to demonstrate is that we can do that for newspapers and magazines. We can do that for DVDs and entertainment products. And this year we've added books too. There are lots of other products that we can distribute on behalf of publishers or clients to our retail customers. So that's a good example of that. There's another example for our small independent customers, which we call Smiths News Recycle. So a year ago, we set up a new service offer for our independent customers, whereby we will collect their unused plastic and cardboard and bring it back to our depots. And we then bale that and sell it on for recyclable value. We charge our customers for that. And that's gone from a 100 customer trial just a few months ago to we now have 4,000 customers that we collect that product from every single day. So it's good for us because we're going there anyway, so we can access marginal costs. It's great margin drop through for us, which is even better. It works for the retailer because our price point is economic, and actually it's good for the environment because we're collecting and recycling product.
And presumably you're deepening your relationship with your customer at the same time.
Exactly right. So our strategy is all about doing more for our publisher clients, doing more for our retail customers, but not taking our eye off the big cash generator in our business, which is the wholesale of newspapers and magazines. And we still distribute 14.5 million newspapers every week and 4 million magazines every week. So the magazine is still a large market, and we expect it to be so for a very long time to come.
How are you keeping a lid on costs right now? Because obviously I imagine fuel is a big chunk of your overall expenses.
Yeah, I mean, I would say our inflationary costs are probably 2 to 3 times greater than we would normally expect to experience. Actually, we have a really strong and proven track record of taking scale costs out of our business. Typically, we take somewhere between 4 and 5 million a year out of our cost base, and that's helping us offset those inflationary pressures. So actually, in terms of core competencies, it's one of the things our business does really well. And in an inflationary environment, it's a capability that we're really pleased to have.
And what about wages? Obviously, getting people to work in the middle of the night, unsociable hours, it's not to everyone's taste.
No, it's not to everyone's taste, but for some people, it really works well for their lifestyle. So we outsource a lot of our deliveries to subcontract drivers. We have about 1,000 subcontract drivers who come and do a few hours work for us in the morning and then typically go and work for somebody else, and they like that. And we have a lot of night staff as well who do that. Then they go home and maybe they've got childcare arrangements or something else. So you're absolutely right. It's not for everybody, but we're very fortunate. We've got an incredibly dedicated team of night managers.
Jonathan, and got to leave it there, I'm afraid. Thanks very much for joining me today. That's it. I'm back at 4:30 this afternoon. See you then. Cheerio.